Welcome to The Explainer. I'm absolutely pumped to have you here today, especially if you're a focused learner really looking to level up how you understand the markets. Because today we're going to initiate a fundamental shift in how you look at trading charts, literally forever. We are peeling back the curtain on the actual raw mechanics of the financial markets to decode order flow.
You know, there's one single, absolutely critical question that separates the pros from everyone else, and it's this: where is money entering the market? I really want you to keep this in the back of your mind because this is the core mystery we're going to solve today. In trading, order flow is basically the study of how buyers and sellers are interacting in real time. It helps you see exactly who's in control right before the price makes a massive move. It answers this exact question.
So the crucial point is, this is the core paradigm shift that separates the retail illusion from professional reality. Most beginners, well, they stare at candlesticks kind of trying to guess the future based on the past. But candlesticks, they only show you what already happened. Order flow, on the other hand, shows you exactly why it happened. It takes you right behind the scenes to the raw data of buyers and sellers clashing, in real time.
Okay, let's dive into this. Here's our roadmap for demystifying institutional order flow. We'll start with the engine of price, then check out the magnet of liquidity, move into reading the order flow, apply it to smart money trade setups, and wrap it all up with the professional mindset. Let's get to it.
Starting with Section 1, the engine of price, aggressive versus passive orders.
So look, price doesn't just move randomly. It's a constant, real-time battle between buyers and sellers. On one side of the table, we've got market orders. These are your aggressive orders. When buyers just spam the buy button at the current market price, they consume the available supply, which pumps assets, like gold, instantly. On the flip side, we have limit orders. These are passive. They're pending orders just waiting in the market. Think of large banks placing huge sell limits. It's literally like pouring concrete to build a massive wall right above the current price. When the price reaches that level, boom, it hits the wall and reacts downward. So aggressive orders push the price, while passive limit orders act as the boundaries.
Moving on to Section 2, the magnet of liquidity, hunting the stops.
All right, now that we know how price moves, we really need to understand why it moves to very specific areas. And the answer to that is liquidity. Basically, liquidity represents areas in the market where a massive amount of stop losses or pending orders are just resting. Why does this matter to us? Well, because smart money, the large institutions and banks, they trade with massive volume. They can't just click buy without totally spiking the price against themselves. So, to fill their huge orders, they actively target these high liquidity areas. They quite literally need your sell stops to fuel their buy positions.
So, where exactly do these institutions hunt? They're looking for equal highs, equal lows, previous daily extremes, and the stops resting just beyond those obvious trend lines. And the crazy thing is, traditional textbooks actually teach retail traders to put their stop losses in these exact, super obvious areas. It essentially turns them into sitting ducks for institutional stop hunts. Smart money just pushes the price right into these zones, grabs the liquidity to fill their massive orders, and then wham, reverses the market.
Section 3. Reading the order flow, following the footprints.
The really great news here is that you don't need expensive footprint software to see when buyers are completely dominating the market. When bullish order flow is in control, the chart leaves these unmistakable clues. Now, what's really interesting about this slide is how clear the signs are. You'll see higher highs and higher lows. You'll notice strong, aggressive bullish candles displacing the price upward, followed by very small, weak pullbacks. You'll see upward breaks of market structure, and most importantly, you'll see buyers stepping in to fiercely defend demand zones. When you see this specific list happening, you know for sure that aggressive buyers are in the driver's seat.
Conversely, when sellers have total control, the whole order flow flips. You're looking for lower highs and lower lows, heavy bearish displacement pushing the market down, and really weak, anemic, bullish pullbacks that just get instantly overwhelmed. The structure breaks downward, and sellers continuously defend their supply zones. This is exactly what it looks like when massive sell orders are just flooding the engine.
All right, Section 4, smart money trade setups, the execution.
Okay, here is your ultimate buy setup, and it starts with patience. You gotta wait for the trap to spring, specifically a liquidity sweep below obvious retail lows. Immediately after that stop hunt, you need proof that aggressive buyers have actually stepped in. This is shown by a strong bullish candle that physically breaks market structure upwards. Once that trap is set, you simply wait for a retracement back into the demand zone and then execute your entry. You're literally piggybacking on the smart money here.
Let's move to and see how this builds for the sell setup, which is the exact inverse. Breakout traders get trapped as price sweeps liquidity above equal highs, hitting their stop losses.
Then, a massive bearish displacement candle drops, breaking structure downward. You just wait for the dust to settle, let the price pull back into a supply zone, and execute your sell. That entire sequence visually represents bearish order flow shifting control right there in real time.
Now, order flow thrives on volume and volatility. The absolute best markets for this are gold, XAU/USD, highly liquid Forex pairs like GBP/JPY and USD/JPY, as well as futures and crypto. But remember, timing is everything. You want to hunt for these setups specifically during the London Open and the New York Open. Why? Because that's exactly when trillions of dollars of institutional volume wake up and absolutely flood the engine.
Bringing us to Section 5, the professional mindset, truth versus illusion.
This right here is the dividing line between endless frustration and real consistency. Most beginners, well, they're trapped in this chaotic cycle of FOMO. They're trading lagging indicators, chasing massive candles way after the move is already over, and entering almost randomly. But professional traders, they're calm. They anticipate. They follow the liquidity. They respect market structure, and they read the raw order flow to see who is actually in control before risking a single dime.
And that brings us right back to our very first question. Where is money entering the market? Look, if you're staring at lagging indicators, you're already too late. You've got to ditch the illusion and focus on the undeniable reality of buyers and sellers. So next time you open a chart, I want you to ask yourself one simple question before you ever click a button. Are you reading the order flow to spot the trap, or are you about to become the liquidity for someone else's trade? Keep studying the flow, stay focused, and I'll catch you on the next explainer.